Hey everyone, and welcome. Today we are pulling back the curtain on the hidden rules that kind of run your life, or at least your shopping habits. Seriously, behind every single thing you buy, there's this powerful economic logic at play, and we're gonna figure it out together. I mean, think about it for a second. Your favorite soda is 2 for 1? You're probably grabbing an armful, right? Stocking up. But what if gas is 10 cents cheaper? You just fill your tank like you always do. So what's the deal? By the time we're done here, you're gonna know exactly what's going on.
Okay, so let's start at square one. We've got to talk about the most fundamental relationship in all of economics, the connection between how much something costs and how much of it we actually want to buy. This is the bedrock of, well, everything else.
So how do businesses predict what we'll do? They use this cool little tool called a demand function. Honestly, just think of it as a recipe. It's a formula that tells them how our desire for something changes when the price tag moves up or down. It's really the math behind our decisions. Let's see this thing in action. Look at this simple formula for a smartphone. If you plug in a price of 40 bucks, the formula spits out that people will want 20 of them. But check this out, drop that price down to just $20 and bam, the quantity people want jumps all the way to 60. It's a super clear pattern. The lower the price, the higher the demand. But let's be real, formulas can feel a little abstract, can't they? So let's do something way better. Let's actually visualize this. We're gonna turn that math into a picture. And that picture is called a demand curve. It's literally just the demand function drawn out on a graph. And you see how it slopes down? That one simple line tells you the whole story. As the price drops, the quantity people want to buy goes up. Simple as that. Think about pizza night. If a slice is $5, maybe your town only buys 100 slices total. But if you drop that price to $2 a slice, suddenly everybody's having a pizza party and they're buying 300 slices. If you put those dots on a graph, you'd get that perfect classic downward sloping demand curve. So, okay, we've established that when prices fall, we buy more. But the real million-dollar question for any business is, how much more? And that's exactly what we're diving into next, how sensitive we really are to these price changes. That sensitivity has a name. It's called Elasticity of Demand. And listen, this isn't just some dusty academic term. This is probably the single most important number for any company trying to sell you something. It tells them if a price cut will just cause a little bump in sales or a total tidal wave. For example, right, imagine a movie theater raises ticket prices by 10%, and in response, attendance plummets by 15%. All you do is divide that drop in demand, the 15%, by the price hike, the 10%. What do you get? 1.5. And since that number is bigger than 1, it tells us that demand was super sensitive, or as economists say, it was elastic. So this really breaks down into two huge categories. On one hand, you've got elastic demand. That's our soda example. If one brand gets pricey, you've got tons of other options. You're very sensitive. But on the other hand, you've got inelastic demand, and that's our gasoline example. The price goes up, you're not happy about it, but you still gotta drive to work, right? Your demand doesn't really change that much. You're just not that sensitive. Okay, now let's take these ideas to the absolute extreme. First, perfectly elastic demand. This is where the buyer has all the power. A perfect example is currency exchange. If one place offers you a euro for $1.10 and the booth next door wants $1.11, you're gonna buy exactly 0 from the more expensive one. The tiniest price difference completely wipes out their demand. And then you have the complete opposite, perfectly inelastic. This is where the buyer has 0 sensitivity to price. Think about a life-saving medicine that has no alternative. A patient needs 1 dose a day to live. It doesn't matter if it costs $1 or $1,000. They demand that exact same amount. Price has no effect on their decision whatsoever. So we've talked a lot about price, but there's another massive piece to this puzzle we can't ignore, your income. So for our last section, let's look at how a change in your paycheck can totally flip the script on what you decide to buy. I want you to really think about this for a second. You just got a nice raise at work. What's the first thing you are just so happy to stop buying? You know, that cheaper brand you settled for, or that less convenient option? Well, whatever it is, that product has a special name in economics. It's called an inferior good. Now, don't get hung up on the word inferior. It doesn't mean the product is bad or low quality. It's just the official term for any product you buy less of as your income goes up. Because, when you have more money, you upgrade to something you like better. So the classic examples are things like instant ramen. Once you get that raise, you might start buying fresh pasta instead. Or maybe you stop buying bus tokens because you can finally get a car. In both of those cases, your demand for the inferior good, the ramen, the tokens, goes down as your income goes up. All right, get ready because this is a real mind bender. We've spent this whole time saying a higher price means lower demand. It's the first rule of economics. But what if I told you there's a super rare, bizarre exception where a price increase actually makes people buy more of something? These are called Giffen goods. And this wild paradox works like this. Imagine a very poor family whose diet is mostly cheap potatoes and maybe a tiny bit of more expensive meat. Now, what happens if the price of potatoes goes up? Well, their budget is totally crushed. They can't afford any meat now. So just to get enough calories to survive, they're forced to buy even more of the now more expensive potatoes. It's this incredible situation where poverty just completely overrules the normal laws of supply and demand. So, what have we really done here? This is more than just a list of vocabulary. You've basically just been handed an economic toolkit. Now you can decode the why behind sales and price hikes. You can see why governments put taxes on things like gas. And you can recognize the forces that are shaping your own choices every single day. And that brings me to one last thing for you to think about. Using everything we just talked about, take a look at your own budget. What is the one inelastic thing that has the most power over your wallet? Is it your rent, your phone bill, your morning coffee? Figuring that out, well, that's the first step to becoming the master of your own personal economy.